The VVIX just hit 120, and the VIX is sitting at 25. If you know how to read this relationship, you have information that most traders are currently completely oblivious to. The VVIX is the volatility of the volatility index. It tells you how uncertain the market is about its very own fear forecast. In today's video, we're going to cover what these levels mean, how to trade the VVIX to VIX ratio, and what the current reading suggests for your next move. Now let's start first with understanding what does the VVIX actually measure. That's key to everything. The VVIX measures the expected 30-day volatility of the VIX itself. It uses the same calculation methodology as the VIX itself, but where the VIX uses the S&P 500 options, the VVIX looks at VIX options instead. So you get a reading more on how the VIX is expected to move. Now the long-term mean is about 86, and the normal range for the VVIX is anywhere from 75 to 100. Anything above 120 is elevated. Anything below 70 is unusually calm. Right now, we're at 120. That puts us right at the threshold where historically the market expects large, rapid moves in the VIX over the next 30 days. I want to say that one more time. That's in the VIX, not in the S&P 500. The VVIX has only been above 120 on about 8% of trading days since 2006. So this isn't something that happens often. It's a little bit more of an unusual activity. Now here's how the VVIX differs from the VIX. The VIX tells you how much implied volatility is priced into S&P 500 options. The VVIX tells you how stable that estimate is. How much can you rely on it? These two are related, but it's important to note that they are not interchangeable. You need to look at each value independently. The VIX has a long-term mean around 19.5 with a mean reversion half-life of about 15 trading days. The VVIX has a mean around 86 with a half-life of only 5 to 8 trading days. That 40% faster mean reversion rate is critical. The VVIX spikes are short-lived. They tend to snap back much quicker before the VIX actually does. The correlation between daily VIX and VVIX changes runs around 0.50. They usually move together during stress and they fall together during calm, but the divergences at some of these key turning points is where you'll find the clues, the best signals that we can then pay attention to. Now, if we take a look at where we're at right now, VVIX at the time of making this video was 120.12. VIX is at 25.26, and SPY is trading right around 658 after recovering from the April lows, which were closer to 560. The VVIX to VIX ratio currently with these values is about 4.75. That's right in the middle of the normal 4.0 to 6.0 range. The long-term median of this ratio is 4.5. So despite the VIX or VVIX, being at an absolute or elevated absolute level, the ratio isn't yet flashing that quote-unquote contrarian signal. What does this tell you? So what do you actually do with this information? Well, A, it tells you the market is expecting the VIX to move, and B, it tells you that the VIX options are priced correctly for that expectation right now. But the positioning isn't stretched in either direction. You're not seeing the cheap VIX options that appear after a spike has exhausted itself, and you're not seeing the expensive VIX calls that precede a volatility expansion. The VIX at 25 is elevated compared to the longer-term average of 19.5, but it's still well below our extreme zone, which is closer to 30 to 35. We've seen the VIX spike to about 60 plus during real panics. Current levels reflect elevated concern, but surely not capitulation. Now, when would this ratio be used as a contrarian signal? Well, this ratio starts to normalize the relationship between really two things. One, volatility uncertainty, and two, the absolute VIX level. This is where you start to get some of the actionable signals if you pay attention to the relationship between these two factors. So when this ratio between the VVIX to VIX, so when that ratio drops below 3.5, I found that to be a good contrarian, bullish signal for equities. It typically shows up after a sell-off has pushed the VIX higher, but VIX option demand has already started to fade. The most aggressive hedging is done, and historically after this period, the S&P 500 posts an above average 20-day forward return. Now, on the flip side, when the ratio pushes above 6.0, so this is the VVIX to VIX ratio, when that's above 6.0, that's a warning. The VIX is relatively low, but traders are starting to load into VIX options anticipating something to come, the calm before the storm to come. This happened before Feb 2018, and this also happened before some of the pullbacks in 2019. At 4.75, we're currently neutral. There's no strong contrarian signal in either direction. We're not above 6.0, we're not below 3.5. Currently, the market is pricing volatility appropriately for the current conditions, so no edge that we can take advantage of. Now, why does this VVIX mean reversion matter? Why should you pay attention to that in addition to the VIX? Well, the VVIX I found is one of the most reliably mean reverting indicators in finance, and I think part of that might also be because it's lesser used compared to the VIX. Academic research shows that the half-life of 5 to 8 trading days compared to 15 trading days for the VIX is where you can suddenly start to add a major edge to your trading. After reaching a reading above 120, the VVIX typically starts to return back to its 80 to 100 normal range that we talked about within about 7 to 12 trading days, even when the VIX stays elevated. And this asymmetry right here between the VVIX and the VIX is where you have this timing window of opportunity for you to take advantage of. The VVIX starts reverting 2 to 4 trading days before the VIX begins its own decline, so it's a preceding indicator. So when you see the VVIX spike above 120, and then we see something like a lower close, to me that's often your early signal that peak hedging demand has passed, and now you can start to look at some potential trade setups. With VVIX right at 120 today, we're watching for that first lower close as a potential timing signal. Hasn't happened yet. Now, what high VVIX readings mean for forward returns is another factor that you want to pay attention to understand this entire concept. Historically, VVIX readings above 120 have coincided with, or slightly preceded rather, S&P 500 drawdowns. But the forward returns tell a different story altogether. So if you look at between 2006 to 2025, that's what I used for this activity, the average 10-day forward return on the S&P 500 after a VVIX close above 120 was positive, roughly 1.2% positive. Extreme VVIX often marks that zone of peak uncertainty as opposed to what I think in the moment we would consider to be the start of a new downtrend. It's not. It's actually where you might find some opportunities. Now, you can't apply this as a blank slate to every single time the VVIX is above 120. There have been several moments in history where we've broken this rule. Look at 2008 financial crisis, great example where the VVIX spent weeks above 120 while the S&P continued to keep falling. So not a good signal at that time. The signal works best when you combine it with evidence that the VIX has already spiked and is starting to fade. It's beginning to flatten, and you can use the options here as a clue. VVIX readings above 140 are rarer than even the 120 ones, fewer than 2% of trading days versus the 8% for 120. Those prints aligned with major dislocations. So COVID was a great example. March 2020 saw VVIX shoot above 200 during that moment. Feb 2018 was another period when it hit 170. So a few different moments where we've really broken the norms. Now, finally, it's important to understand how institutions use VVIX so you know how the big players are actually looking at this. Institutional desks use VVIX for four main things. 1. Tail risk timing. 2. Hedge cost evaluation. 3. Volatility surface analysis. And 4. Regime transition detection. Now, when VVIX is low, below 80, VIX calls are typically cheap. And that's when you'll find large funds will scale into protective positions. When VVIX is elevated above 110, that same hedge is expensive. So at this point, institutions may shift to alternatives like SPX put spreads or even callers. Now, a rising VVIX during a calm equity market is this major red flag. It means somebody out there is paying up for protection before anything has even happened in price. Portfolio managers at pension funds, endowments track VVIX to decide when it's time to renew their VIX options positions versus let them expire and help determine their hedging activity. Now, what do we do with all of this information? Again, bringing this back to where we're currently at. The VVIX is at 120, VIX is at 25. So let's start with going through this systematically. First, let's recognize where we are. The SPY has rallied from 560 in April to 658 now. That's nearly an 18% move. VIX is elevated, but not extreme. VVIX is at the threshold of our elevated zone of 120. Second, we look at the ratio between VVIX and VIX. Currently, this ratio is at 4.75. So you're not getting a strong enough contrarian signal, in my opinion. You're in wait and see territory. If VVIX climbs higher while the VIX stays flat, that ratio would start to push 6.0, and that's where it starts to become an early warning signal. 3. Look at the VVIX for a mean reversion. If we start to see the VVIX prints a lower close from here and starts reverting back towards the level 100, that's often that early sign that the VIX will follow as well. That could align with a nice entry for longs instead of shorts. That's where we know that the sphere is over and we can now start to look at entering back in the market for long side positions. Finally, fourth, if you're considering VIX options for hedging, understand that VVIX at 120 currently means by definition you are paying an elevated premium. A VIX 30 call today costs more than it would if, say, the VVIX was trading at 85. So use that to A, determine your sizing, and B, determine how many you would want to actually buy. You can also use things like the market pulse to track volatility regime transitions across all of the different symbols in the market to understand when we might be changing from, say, a stage of acceleration to deceleration, or vice versa for long positions. When VVIX signals a shift, you can see which symbols confirm that move and which diverge. You can learn more on our website, volatilitybox.com. I'll leave a link to a blog post which breaks down the VVIX versus VIX in a little bit more detail with some charts and some graphics in case you're interested. Hope you found this video helpful for those of you looking to make sense of the volatility index and how to use it in conjunction with the VIX. Take care, and I'll see you in our next update.